Welcome to Brokers Digest, a weekly webcast by The Edge Singapore, where we discover stock opportunities with you. This episode is made possible by TD Ameritrade Singapore.
Welcome to another episode of The Edge Singapore's Brokers Digest. I'm Amala Balakrishna, and today I will take you through how to assess the investment worthiness of an exchange-traded fund, or an ETF in short. Today's episode will be an interesting one because we'll be joined by a different guest. Here with me is Leonard Ng, Manager for the Trade Desk of TD Ameritrade Singapore. Hello Leonard, welcome to the show.
Hi Amala, thanks for having me.
Thank you for joining us. Now, before we touch on ETFs, Leonard, since you are a trading expert, I have some trade-related questions for you. Friday saw the end to a solid week, with stocks rising broadly as traders responded to the latest news on the White House's interest in passing a comprehensive stimulus deal prior to the presidential election happening in November. The reaction comes after President Donald Trump previously called off stimulus negotiations in the week earlier. At that time, he had called for what market watchers call a skinny version of stimulus, which would have included aid to the languishing airline industry as well as direct payments to Americans. Stocks posted their biggest weekly increase in the past 5 weeks. The S&P 500 index climbed 3.84% week on week to 3,477.10 points, while the Dow Jones Industrial Average was up 0.6% to 28,586.97 points. Meanwhile, the Nasdaq Composite Index increased 4.56% week on week to 11,579.95 points, and the tech-heavy Nasdaq 100 Index jumped 4.18% week on week to 11,725.85 points. Now that's a lot of jumps to the indices, especially since these indices had ended the week before on a decline. So Leonard, I just want to know, what is the status of this stimulus? Is it really happening?
Yep, it looks like that. As you can see, the market has reacted well with the hearing of the stimulus. This is good that cash is continuing to flow into the market, and we hope that it can be continuous. The tap can be kept on, so that the market can be buoy, and especially coming up to the upcoming election. So that is very key, that Trump does whatever that he can to keep the money flowing, the confidence in the market, so that the voters can get him back into his presidency.
Right, thanks. So how do you see TD Ameritrade's Asian customers' trades been in the last few weeks? So what counters are you seeing them buying?
For myself, I took an even longer approach, including not just this current month. For the entire year, I've been tracking them. The client base for the Asian side comprises of not just Singapore investors, Malaysian investors. We have also coverage from China side, as well as the Taiwanese. So it's really a pan-Asian, I would say, a mix that you can see that is buying up these shares. So we have the top 3 traded stocks that we have that are being bought by TD Ameritrade clients in Asia. The first one would be Tesla, TSLA, and the second we have Apple, and then third would be Amazon.
Right. So Leonard, do you actually see that your clients from US and the rest of the world are also showing a similar appetite and interest for these 3 counters that you mentioned?
Yes, quite similar, surprisingly. I would think that the pandemic affects everyone the same way, in which you can see Amazon and Apple, they are tech stocks. So when during this season, TD Ameritrade clients use the market volatility to add to positions during this September period, and they were net buyers of Apple, Tesla during this time. So every time there is a all-time high early in the period, but it sold off. That's where we see our Asian customers add on to their positions.
Right, Leonard. I think at this point, I also want to touch upon the results for TD Ameritrade's Investor Movement Index. I think based on your responses, you alluded to a bit of the findings that came out in that. The Investor Movement Index, also short for IMX for September, I believe it came out last week. So we have the slide over here explaining it. Maybe, Leonard, you could take us through this chart.
Sure. So as you may see, the IMX, or the Investor Movement Index, is a proprietary behavior-based index. So it's unlike the typical S&P 500, where it is comprises of the stock components. For us, we are trying to peer into the behavior of TD Ameritrade clients, and then share it as an indication of a sentiment from the retail perspective. So with that, we create a monthly sample that includes all our retail customers, individual self-directed investors, and then what they have traded over the month of September. The overall IMX score, as you see, it is quite democratic. If you have a large portfolio, a small portfolio, you will have the same influence on the score. All right. So as you can see, the IMX index for September went up. The climb is very steep. Nevertheless, it is still recording an increasing of I would say 5.71 points upwards when compared to the previous August point of reading of 4.93.
Wow, that's quite a big jump, Leonard. Do you expect to see such a big jump in October's readings that will come out next month?
I would say so, yes. I would say because as you can see the trajectory, it depends on the overall pandemic situation. If everyone continues to work from home, and then and I would say heavily in line with the US election, I would say that the investors would continue the same trajectory. As I will explain later on, that why are we seeing some behaviors when it comes to tech stocks.
Right, right. So you mentioned that tech stocks, ICT, and consumer discretionary services were very popular in September, and now you're mentioning that you expect this trend to continue. Earlier, you mentioned Tesla, Apple, and Amazon as the big names. So rather big names over here, Leonard. So maybe you could take us through why you think these counters have performed well among TD Ameritrade's customers last month, and why you think this will be the trend going forward, like you said, with people working from home more, and the take-up rate for the services from these companies being high in the months ahead as well.
Sure. So firstly, they are household name brands. For consumers, they would not need to think a lot when coming to purchasing decisions. The household, I would say the brand name is there, the brand equity is out there. So with Amazon, with Tesla, with Apple, so these are very, very renowned brand names. So secondly, as you see, we have seen recent stock splits for Apple and for Tesla. So for what does it mean for investors? So stock splits gives investors more opportunities to own shares. That by increasing the granularity of the share price, which means each share price now is much cheaper to own. So this gives opportunities for investors, be it the ones with larger pockets or smaller pockets, to own and get a piece of the action. So in terms of the market action itself, or the corporate actions that the stocks come forth, they are also giving opportunities for the investors out there to pick up these household brand names. And the last point would be the current and future potential. So currently, as we can see, in a phase of pandemic, tech really rules to bridge the physical divide.
Well said, Leonard. Well said. I think if not for tech, so many things couldn't have been done in terms of connecting with our colleagues, doing work, as well as keeping up to what our friends and family members have been doing. So against this backdrop, the market is showing signs of an uptrend. It seems too early to tell if this trend will persist, especially after the volatility the stock market has been facing in the past few weeks. So actually, Leonard, I'm very, very curious to know if ETFs will make a good investment product. They seem to have become rather popular lately, so I'm not sure. Maybe, Leonard, why do you think this is so?
I would say ETFs are very diverse. So it has capabilities of being broad-based as well as being very focused. It depends on the assets that the ETF are tracking. So, and it can be very, I would say, granular. So like I mentioned earlier with stock splits, ETFs can be very, I would say, cheap or modular. So in which it can augment your own portfolio, or it can comprise the majority of your portfolio. So it is very flexible. And some of the ETFs are very liquid, and also the ETFs, depending if it's very broad-based, it follows, for example, the S&P 500. So you don't have to really spend money to buy all 500 shares of the S&P, but instead you can have access to the same exposure with just one share of the ETF. So that is the crux of attractiveness of the ETF.
Right, right. So maybe, Leonard, is there any platform that TD Ameritrade offers that investors can look into to learn more about ETFs, to understand how an ETF works, and perhaps to see whether a particular ETF is worth buying or not?
Sure. So here we go. On our website, you can see tools and platforms. So on the left, we have trading avenues or trading platforms for you to trade and learn more about the product. So
Right. It's actually quite a useful tool, I must say. Perhaps if viewers have any particular questions that they may have on ETFs, they can possibly type that out and find that out. So just like that, I have two questions for you right now. There are two terms whenever I think about ETFs, I often look at these two terms: leveraged ETFs and inverse ETFs. Maybe, Leonard, could you explain to us how they work, please?
So for the inverse ETF is actually constructed by using various derivatives. Derivatives can go up or down. You can long or short it. And that's where it goes into the inverse ETF. It can profit from a decline in the value of an underlying benchmark. So it can be an asset, it can be a price, it can be a commodity. And then with leverage ETF, it also uses financial derivatives, which has the leverage component. It also can add on some debt, and then it can amplify the returns of an underlying index. So that comprises of what a leverage ETF is.
Thanks, Leonard. Okay, that's quite a detailed description on how these two instruments work. So maybe at this juncture, in terms of, you mentioned certain ETFs that we can look at, but how about we look at them in terms of based on their market size? So first off, let's look at the mega and large cap ETFs, which have and how they've been doing for the last 6 months. So this category comprises counters with a market capitalization of over 100 billion US dollars. So maybe, Leonard, you could take us through this chart. We see the SPDR S&P 500 ETF Trust, which you mentioned earlier, having the highest average volume traded, whereas the iShares Russell 2000 ETF has the highest value traded over market cap percentage. So really, I think these are two different matrices. And what should we be looking at when investing in an ETF? Which metric should we be looking at? Or is there some other parameter that you would suggest for investors to look at instead?
For this, I have a few metrics or considerations. First, I would just keep it simple. So we have market cap, we have average volume traded, and what does it stand behind them? So market cap itself would tell you how big or how large the ETF is, and then you can know like how much money which the investor would have invested, be it from the large size, which is like institutional trader or a fund, or versus or including the retail trader. So in which the smart money are going along with the retail money. So that's where you can use the size or market cap as a proxy for that. Secondly, we can see the volume traded, which is the average volume traded. So that is liquidity. So liquidity is very, very crucial when it comes to trading ETF, because the ones with highest liquidity means there's the most market participants that are trading in the market. So what does it mean to you? So if it's liquid, it can be equivalent of the Singapore dollar exchanging for the ringgit. So which is, we have plenty of Singaporeans exchange, or plenty of people exchanging ringgit versus Singapore, in which we have plenty of supplies, plenty of demands, and then the bid and ask spread are narrow. So you don't have to pay something called a slippage, which, for example, you're exchanging Singapore dollar for Norwegian kroner. So in which for certain ETFs, like such a versus an exotic currency, where the buy and asking price will be very, very wide. So for those that are very low or thinly traded, so the bid and ask spread can be very wide, and you are just paying extra money to get out of the ETF. So I think when you keep it simple, liquidity and size, which is the market cap, and the volume trade, the value trade, the number of trading frequency is very important.
Right. Okay. Thanks, Leonard, for that. So I think let's move on to the mid-cap ETFs. Over here, we have the slide, which presents counters with a market capitalization ranging from 2 to 10 billion US dollars. So actually, Leonard, I myself am very curious when I look at this list, which ETF to invest in. You mentioned just now liquidity, income returns, and capital appreciation. Would you say that these suggestions also should be what I should be thinking of when I'm looking at these counters as well?
So for mid cap, it's going to be a little bit different, because as you can see, the ETFs are quite focused. They are with a lesser or smaller cap itself. The ETFs will be more focused or more with. You can see it's either I would say a higher risk one when compared. So when you compare commodities versus a standard S&P SPY ETF, in terms of the risk associated with biotech, with commodity ETFs, they are generally higher in beta in terms of the risk associated with them. So with this mid-cap ETFs, it is more, I would say, tactical allocation of your portfolio, rather than versus the large cap, where you are trying to maybe mimic or gain exposure to an index movement. So this is where you want to add variety to your portfolio by looking at the mid-cap ETFs with whichever focus that they are having.
Right. Thanks, Leonard. So we are almost running out of time. Maybe in closing, could you just share with us a few pitfalls or areas that our investors should be cautious of when investing in ETFs?
So I would summarize into 3 points. First is tracking errors. So ETFs itself, sometimes it can be known as a black box. So a black box in which, if you have not heard of it, it is, you can see visually is a box that is black in color. There's nothing, you cannot see what's inside. So it's a closed system. So where if you see that, because the purpose of ETFs are to track an underlying index or asset. And if the tracking is not in line, for example, if there's a 1 point movement up in the S&P index and the ETF doesn't track that movement, it will be very inaccurate to the investor. So you don't know whether are you really gaining that 1 point movement or not. So that is very tricky. So tracking errors is one. So secondly is leveraging. So like I mentioned earlier, for the leverage ETFs, they can be taking on extra debt, which are very, which will increase the risk when it comes to the ETF. With all companies, they are essentially the same. If you take on more debt, the risk of default is much higher. So that is the key. So leveraging, you have to take a look when it comes to ETFs in terms of how much debt they are putting on, how much derivatives that they are trying to use for hedging. All right. So most of the time, derivatives are meant for hedging, but if they are used to create leverage to gain more, I would say alpha, which is the movement of the returns, then you have to be cautious on that. So lastly, like I mentioned earlier, which is liquidity. So liquidity, it's where the market participants are more, so in which you can get in and out without paying a very, very wide bid and ask spread. So you want to get typically into ETFs that are more liquid, that you don't need to pay so much to just cross that that price difference. So instead of, let's say, it is between a 10-cent bid and ask price difference versus a $1 bid and ask price difference, it is very disadvantageous for the investor in terms of trying to get in and out of the ETF itself. So 3 points: tracking errors, leverage, and liquidity.
Wow, that's very, very succinct. Thank you, Leonard, for that. Now, with that, we have come to the end of this week's Brokers Digest discussion. It was a pleasure having you with us, Leonard. Thank you again for your pointers on the markets as well as how to assess an ETF.
Sure. Thank you, Yamala.
Okay. To our viewers, we hope you have a better understanding of ETFs, and this helps in the investment decisions you make in the coming weeks. To know more about ETFs, you can also visit the Investing 101 page on the Edge Singapore or the TD Ameritrade Education Center that Leonard was pointing out just now. So do like us on Facebook and Instagram to be alerted on next week's episode. We will be discussing more investment tips that you won't want to miss. I'm Amala Balakrishna, and we'll see you again next week. Take care. Goodbye.